Hello and welcome to episode 300 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, we made it. We've made the big 300.
We have, and we talked about it in the office, didn't we? And said, are we going to do anything to celebrate it? But we're passing these milestones at a rate of knots, and we just decided to almost nonchalantly go through the 300 without really marking it, didn't we? Because I suppose we did the 100, the 250. We're going to mark the 500 is the next goal, isn't it, Andy? So we've kind of gone through as the seasoned pros of the podcast. But it's something to be proud of, 300 episodes of the weekly podcast, because we talked about it again recently where we were talking about the content, and Andy was saying about it's not easy, is it, coming up with 3 pieces of evergreen content every week that you haven't discussed in detail before or even discussed before. So we'll pat ourselves on the back on that one before we move swiftly on, I think.
Yeah, we should. I haven't done the maths yet, but 500 is obviously 200 episodes away. 50, yeah, it's about 3 or 4. No, it's about 4 years away, I suppose, isn't it? So hopefully our listeners will be still with us and waiting for that celebration episode to happen.
But don't forget, Andy, we've also done the Midweek Markets podcast. We've gone way over a year's worth of those. So that's another batch of podcasts that we can add to our number. So yeah, it's been amazing. Just a shame that we can't meet the podcast listeners for a meetup at the moment. That is the shame of it, because the 300th episode would have been quite nice to do something with them. And we could have gone out to the pub like we've done in the past and had a beer. And we always seem to end up celebrating around about this time of year anyway, don't we? We do like the meetups and stuff like that. So it's a shame we can't do that. Maybe we could do a postponed 300th mini celebration drink in the new year when hopefully COVID is behind us all. But maybe I'm just being optimistic.
It's a real shame we haven't been able to meet up, but we'll certainly be raising a beer. Hopefully our listeners will too. And we'll see them soon. We'll just keep everything crossed that we can do more meetups in person in the new year. We've got to keep everything crossed. Anyway, 300th marked. What are we talking about this week? What have we got on the pod?
There were 2 investment pieces I'm going to focus on before you finish off the podcast with a piece. Before we do that, I just wanted to, it leads into the first piece actually, which is why I want to talk about it. But we often ask people to send in feedback, review the podcast and emails. And it's not just because we want people to say nice things about us. It's because it is very motivating for us and the team when people do send in things and do give back feedback on the show, review the podcast. It does help us in the iTunes charts. But I just wanted to briefly talk about an email that I got this week. And I'm not going to talk about the person personally. I'm going to keep it anonymous. I received an email from somebody this week who talked about the fact that they had struggled or do struggle with mental health problems. So anxiety and depression. And they've had that for a number of years. And there have been certain triggers that they now know about which cause their mental health to deteriorate. And one of them has always been money and centered around money. And the email goes on and gives a story of their life in recent years. And in the email, the person talks about discovering the Money to the Masses podcast and then saying how they focused purely on their investment returns, trying to control that, to be able to control their money. I thought it was all about that was causing anxiety. And then they did the money MOT, and to use their own words, saying they said it was a light bulb moment. And after doing that MOT, they realized it was about controlling their money rather than their investments, and looking at the broader church of money, if we use that term. So basically looking at every aspect and just trying to control it rather than obsessing about the individual investment returns, something you have no control over. And they go on and talk about the MOT and listen to the podcast, and how listening to the podcast changed their view on how to make decisions on their money, about obviously, I mean, I always go on about not worrying about perfection when it comes to making decisions with money, and about being realistic, and also not beating yourself up. And they go on and conclude the email by saying how much the podcast has helped their mental health over the years, and thanked us for that. So it was an amazing email, and they asked me to share it with the team, and I did so. And the email was obviously is a great story, very well written, and a few of the team actually got a bit cheery when they read it, because what it showed is what we're doing on Money to the Masses in a better way than I could probably articulate myself, and the impact we have. It isn't just about monetary stuff. It's not just necessarily about the action points people take, but the well-being and mental side of their lives too, which for me was a massive personal highlight, an achievement, if you will. So thank you for the person who sent that in. It's incredibly motivating. In the new year, we may even do a few more bits about well-being and money as well. So thank you for that. But what I wanted to say, that then leads on nicely to one of the pieces I'm going to do on the podcast. So the first investment piece I'm going to do is about mindset, really, when it comes to investing money. And it's about the idea of being a perma bull or bear. So people tend to get caught up in a view on the market. And I want to discuss that and to teach them how they can stop doing that and why they shouldn't. And the other one is I want to talk about the Santa Rally. Now, if you go back many moons, episode 41, I touched upon the Santa Rally, but I've done some new research for 80/20 investors this week, and there's some interesting insights on the phenomenon that is the Santa Rally that I want to share with people that they won't have heard before. And of course, the last piece of the podcast is I'm going to pass over to you, Andy, and it's going to be on...
Mine is just a quick FYI, really, about a scam that does the rounds every sort of December time. The FCA have issued another warning about it this year, and there's 3 key things to look out for, and I'll be covering that later in the pod. Okay, so what are we going to start with this week?
So the first piece I want to do is the investment piece. And now, as I mentioned in the intro, it's about mindset, really. And I was reading some bits and pieces this week, and the idea of being a perma bull or a perma bear, by that I mean there are people out there who hold a view on the market that is permanently bearish or permanently bullish. Now, if you're bearish, that means you're very negative in your outlook. You think the world's going to cave in and you think that the market's going to collapse. If you're very bullish all the time, you just think no matter what happens, the markets can only go upwards. Now, I'm going to focus more on the bearish side, but what I say is relevant to both being bearish and bullish. But particularly the bearish angle is an interesting one. Now, I've worked with a lot of people in the industry. I've read a lot of people's commentary, research. I've been part of a lot of pieces in the press where I'm asked for comments on investing. And there is one thing that has always almost marveled me. There are people out there who are permanently doom and gloom. They will sit there and say, oh, the market's going to correct. We're going to have a crash. This is ridiculous. All the money printing from the central banks is going to cause hyperinflation. The world is going to end. It's all going to end in tears. We're going to get a 50% correction. And I have people regularly send in emails they receive from some of these people, almost newsletters, to say, what do you think of this view? And one thing I want to point out is that if you are permanently saying the world is going to end, eventually one day you will be proved right. The trouble is you probably won't be alive to see it, but you eventually will be proved right to a certain degree. So the point is that people who are permanently bearish actually hamper their investment returns and their long-term plannings if they want to retire. Because give you a good example, people might have thought that the market was going to crash going into 2020, or it did. And as it did, they decided that they were going to pull their money out. And the market crashed and it went down 20-30%. They said it's going to go even further. This is the beginning of the end. It looks a lot like 2008. And so they pulled their money out, sat in cash. The market may have dipped a little bit more, and they sat there and thought they were geniuses and said, this is it. This is the big one. But they've been saying that for 10 years. Some of these people you read in the press, I know, I've been in the same articles as them, and they permanently keep saying the world's going to end. And the people who might pull their money out and they're waiting for the market to tumble, just grab your stock market app if you've not been following markets at all. But you will know that the market has, if you've invested in US equities anyway, and quite a lot of other global indices, but not the UK, they've rebounded and we've recovered those COVID losses. So they're sitting there in cash on the sideline going, the world's going to end. But we're now seeing all-time highs again around the world. The problem is that their permanently bearish nature means that they are missing out on a recovery. And actually, new all-time highs are hinting that you're more likely to get another new all-time high, as I've done on the podcast previously when I discussed it, than the market to immediately correct. If you look at the numbers, that's what happens. And there are people who have been calling a crash since 2009, and they never hold up and say, look, I was wrong. They just keep going on and on about it. And so what I want to do is think, are you a person who's got that bias? Because when you invest, you don't want to be emotional, whether it's overly bullish or overly bearish. The market is what it is. It will react how it reacts. You can't predict it. You can't predict whether the pound's going to crash on Brexit news or rally. It seems to sometimes to be pretty random. So if you're investing, take the emotion out. Now, here are a couple of questions. Do you, as a person, when you look for articles or you research articles on investing, or you just happen to ones you stop and read, is there an element of confirmation bias? Go back to podcast 185. I talk about biases, and confirmation bias is where you will go and look for information or take note of certain articles, whatever it is, arguments that back up your preconceived ideas, the ideas you already have. So the market's going to crash, and you look, there's an article saying house prices are going to tumble, stock market's going to fall 50% next year, and you're going to stop and read it because it emphasizes your point. I thought that sounds like it's going to happen, and you read the article, but you don't read the ones that tell you the reasons why it might rally 50%. All of this is forecasting. It's all mostly nonsense. But the point is that you will only view information that will confirm the biases you already have. I mean, do you as a person hold on to positions that are losing positions because you believe that they will turn into positive ones in the long run because of the reasons that you hold a particular view? Are you bothered about holding perhaps more equities than you currently do because of a bearish view that you have, or vice versa, less equities than you currently have because you are overly optimistic? So does it bother you when you are holding more money? This is obviously not associated with your risk tolerance or anything like that. You invest in line with your risk tolerance, as I explained before, and there's plenty of articles on the Money to Masses website that explains this. But what I'm talking about here is, does the idea of maybe investing a bit more in a certain area worry you? And that will be part of your risk tolerance. But is it because you think the market's going to collapse? As somebody who does want to invest, for example, who's sat on the sidelines since March, does entering the market now worry them? And that will probably confirm that you've got a bearish view because you're actually in cash. You're not making any money, yet you want to invest. And perhaps you have got a risk tolerance that is above the low risk. You are generally medium, but you're just trying to time the market. This is an indication that you are letting these biases inform your decisions. Do you blame other people like the Fed, like the US Federal Reserve, the Bank of England, or governments for rigging markets? Yeah, I would have been right. The market would have collapsed if it wasn't for the fact that the Fed is manipulating markets and pumping money into the system. How many times have you seen that in the press? It's countless. People saying that the market is rigged. It would have collapsed. I would have been right if it wasn't for X, Y, Z. Even people like Neil Woodford, who failed in his fund, you've seen things where he has mentioned things that he would have been proved right in the long run, whatever reason. Now, he obviously was proved wrong, certainly in the time that he ran that fund, but then you can argue that, was his view incorrect? Is it something that he was holding on to in the belief that would happen in the long run? Do you gloat when you're right? As in, I'll put that inverted commas, right, because maybe the market falls 5%. You say, there you go, I told you it was going to happen. But ultimately, you're looking at a trend that's still up about 50 because you're just looking for the fact to try and be proved right. And so those things are a sign that you have biases, and particularly overly bearish. And so I'll give you an example. When I started running 80-20 Investor, and I started investing in the 50k portfolio that I run live, at the point I did that in March 2015, markets were all-time high. If you'd asked me emotionally, do you want to pump all the money in now? There would have been a huge part of me that would have thought, no, I think the markets could turn lower. But I ignored that, invested on an objective basis with a methodology, and now obviously my portfolio is up over like 43%. And it's because I didn't allow a bearish viewpoint to inform my investment decisions. And it goes back to the email that I received earlier on, is that if you are holding a view on where markets are going to go, then you are looking at things wrongly, because you're looking at it in a way, it's about something you haven't got control of. You're just trying to be proved right. Being proved right doesn't boost your investment returns as such. You don't get a bonus. But the thing is, people are like gamblers in that regard. When they have a bearish view, they only tell you about the time that they're correct. They don't tell you about the fact that they've sat out the 10-year rally, which is probably the biggest rally in history in terms of stock market returns. They will only tell you, yeah, but it's only because it's rigged and it's all going to go belly up and collapse in the future. So what I want people to listen to and bear in mind is that try and change your mindset. Don't have one. Work out whether you're being overly bearish or overly bullish, particularly overly bearish, because it will hamper your returns in the long run. Because at what point do you then decide that you were wrong? And there are some tools I just quickly want to mention. I mean, the best way is to stick to a process to stop this happening. So like the gentleman we talked about, the MOT is actually there's a process in what it does. It goes through, identifies key areas in your finances, gives you a score, then systematically prioritizes them and goes through and tells you what to do in quick steps. That's a process. It's no emotion in it. bit like when I do 80-20 investor, there's no motion. It's very functional about what we do. And again, that is based around trend following. So therefore, when the trend's going up, you follow it, whether you believe it's going to continue or not. If you want to just index and forget, so you want to invest in index funds and you buy and hold and don't look at your portfolio ever and just keep pumping money in on a regular basis, then that will help you avoid being emotionally drawn into being overly bearish on investing, which will hit your returns in the long run. What is funny is I know for a fact there are people running portfolios out there that you see in the media that they don't talk about the returns they have because they've been betting the market's going to implode, and they didn't bet it was going to implode again in 2020, and it's not happened, and they're left licking their wounds and they all go quiet. You don't hear from them until the market pulls back a little bit, but they don't tell you about how much they're still down relatively against everybody else who was probably just net long. The other thing is the idea of stop losses are interesting. If you're trading, of course, the stop loss idea you may be aware of it. A stop loss is basically a system whereby if the market falls, say 5%, then it triggers a notification in which you might then look at your portfolio. We use something called trailing stop losses on 80-20 Investor. You don't have to act on them, but what they do is they tell you when the price of a fund falls by 5% from its recent high. So if the market keeps pushing higher, then the stop loss moves up with it. So it's the 5% for its recent high, not from the 5% from the beginning of the rally, if that makes sense. So they can be quite useful tools, even if you just keep an eye on it on a spreadsheet, just so you know that maybe that if the market starts falling, if you're shorting the market, for example, which some people do, and you get it wrong, then maybe it's time to reassess your view. Equally, if you're overly bullish and the market tumbles, you may want to reassess your view. But one of the things that was very interesting to me when I was looking around this topic is something called a time stop loss. And it's a concept that I'd not really thought about, but I like. And that is a tool like a stop loss, but based on time rather than value of your investments. So let's imagine you had a time frame of, say, 6 months. If after 6 months the world hasn't ended as you predicted, or your bearish view would necessitate for you to be correct, then you call it a day, and then you change your view in line with what's going on with the market because you were wrong. That's the problem, because as human beings, once we nail our colours to the mast, we struggle. It's one of the biases we have. It's called consistency bias. We don't change our viewpoint. We find it very hard to do. We don't like to say we were wrong and then move on and take the same view as everybody else had, who has evidently been proved to be correct. But it's far more profitable to do that in the long run rather than hold a bearish view that is actually completely unfounded. So if you had a time stop loss, so after 6 months you hadn't been proved correct and actually you've been proved wrong, then you draw a line under it and then you reassess the situation. I thought it's a fantastic way of forcing you to realise you are taking a view on the market that is hampering your returns. And it may be an overly bullish or it may be an overly bearish one. So if you feel like you are taking a viewpoint, the market is moving against you, the reassessing it periodically is a great way of making sure that you don't stay consistently wrong and you're just being stubborn in your viewpoint. And again, on 80-20, where I review my portfolio regularly, I naturally end up doing this. I switch out of funds that have lost money. I don't always know if I've made or lost money on it. I don't reference the starting value on the basis of my decision. I'm just looking at the overall value of the portfolio. So to sum up, have a think about your mindset when you're investing. And are you being overly bearish?
Excellent stuff. So moving on to the next piece, and it's another investing piece, and we're going to be talking about a phenomenon called the Santa Rally. Now, we have spoken about it in the past on the podcast a couple of years ago now, and you've done a lot of research this week, primarily for our 80-20 investor members, but you're going to cover a bit on the pod.
Yeah, I mean, it was more than a couple of years ago, because I looked and it was actually episode 41. And so that puts it back when we were working out. That's one of the real early ones. I mean, it's probably about 5 years ago. I think it's 2015. And the reason I wanted to look at the Santa Rally idea again is that we've had a number of years past. We've had some terrible Decembers, particularly 2018 when the market completely tanked. It was the worst December in stock markets for about 80 odd years. And just to give people a reminder, the Santa Rally is a phenomenon where the stock market rallies in the lead up to Christmas. And so there's various definitions of what the period is. Is it the whole of December? Is it the days between December and the new year? But fundamentally, it's December. It's the seasonality that exists in December. So that's what I've taken it to be and looked at. So to give listeners some numbers, I crunched the movements in the US stock market, so the S&P 500 going back to 1994, and looked at the movements between January and November, and then looking at December on its own to see if there is a seasonality effect, and does the market go up more than it should do in December? And by saying it should do, I mean the chances of it going up or down are broadly 50-50. If you look at the numbers over those 26 years, the market has actually risen 19 times in December. So that is a hit rate of 73% that the market rises in December, which is obviously significant. So there is clearly a seasonality in the S&P 500. And the average return in December is just under 1%. It's 0.97%. So I looked at that and thought, do you know what? Does this exist in the UK? Because obviously it's got a definite link with US equities, and that's where you hear people talk about it the most. Now, I looked at the numbers again, the same time period going back to 1994, and actually in the FTSE 100, you saw the value of the index rise on 22 out of 26 occasions. So that's an 85% hit rate. I like those odds. That's a very high. So there's an 85% chance based on that historical time period of the market rising in December in the UK, and the average return is 1.84%. That's almost twice what it is in the US. So taking that information, then you can see that if you want to play this phenomenon, the Santa Rally, you are probably better off playing it in the UK. Despite it having a link to the US, you're better off picking, say, UK equities, because you're more likely for it to happen, and the chances of a higher return in December also exist. So I also then looked at other criteria. For example, like apparently, so people say that tech stocks do well in December in the Santa Rally. So I looked at tech stocks specifically in the US to see if there is the phenomenon in US tech stocks, if the Santa Rally exists there. And I also looked at US election years, because the US election has a way of influencing markets, be it good or bad. And I look at that. I'm not going to tell you what the answers are, whether the fact that there is a US election in the year 2020 makes it more likely or less likely there will be a Santa Rally, or whether tech stocks are a good way to apply the Santa Rally phenomenon. But there are some clear results there. One of them makes it less likely for you to enjoy the Santa Rally, whereas the other increases the chance of a Santa Rally. I won't say which one it is. But one other point I wanted to mention, what people won't have heard of before, because it was only when you look at these numbers and you let them wash over you and you look at it, there seems to be no pattern about what happens in the lead up to December in a given year and to what happens in the December itself. So you sit there and think, well, this kind of feels random. But then when I was looking at the numbers, over the whole 26 years from 1994, when I started the research and up till today, then the average return in the S&P 500 is about 0.97%, as I said. But in the last 20 years, so you just take from 20 years, so from the year 2000 to now, that has dropped to 0.71% average in December since the year 2000. And in the last 10 years, that's dropped down to 0.29%. But what is also interesting is the odds in US equities of a Santa Rally occurring are actually increasing. They go from that 0.73 that I talked about at the beginning, that 73% chance. Now, in the last 10 years, there's an 80% chance. So what it's saying is in US equities, the chances of a Santa Rally are slightly increasing, but actually the benefit of it is falling. You're probably not going to make that much money, certainly much less, almost a third of what you would have done in the past. If you flick over to UK equities, we see the same pattern of the returns falling. So we had 1.84% on average in December since 1994. If you only look at the last 10 years, that drops down to 1.45%. But interestingly, the odds of a Santa Rally are falling over time in UK equities. It was 85%, as I mentioned, over the last 26 years, but in the last 10, it's only 70% chance. So what we're seeing is, broadly speaking, the Santa Rally could almost be the ghost of Christmas past. So the phenomenon seems to be weakening over time. And if I was to speculate as to why, perhaps it's because of all the quantitative easing and monetary policy we've seen in the world. So central banks printing money, keeping interest rates low. If you're flooding the market with easy money, then as that analogy I often talk about the garden, if you water the garden but basically overwater it because it's dry, then the water floods into little puddles. It finds its place and it basically get little pools of water. That's kind of what happens with easy money in central banking terms. It ends up going into certain assets. So like the high risk assets like stocks, it pushes the prices up. So if I was to guess, I would suggest that what we've seen in the last 10 years or so is with all this quantitative easing, we are just seeing that stocks are being pushed higher throughout the year more widely. So it's basically like watering your garden consistently all year round. There is no discernible difference, therefore, between the seasons because you're just constantly watering it all the time. So that is my takeaway on the Santa rally. If you want to know more, then obviously you can sign up to 80/20 Investor and take out a free trial to see the rest of the research. But it just goes to show the phenomena does exist. UK equities seem to be the place where it exists more acutely, but it is fading over time. So we probably won't even mention it by the time we get to that 500th episode that we talked about earlier.
Okay, brilliant stuff. So that's the couple of investing pieces. And I was just going to finish off this pod with a quick piece about a warning that the FCA have announced. And it's regarding a type of fraud that I hadn't actually heard before. It's loan fee fraud. And unbelievably, in December, it accounts for around about 1 in 8 of all scam reports. So it's something to be aware of. Now, I know a lot of our audience are quite well versed in finances and money, but really this is something just to put out there that if you know people, especially with what's happened this year with coronavirus and everything else, if you know people that are maybe struggling or are reaching out looking for credit, this is something just to keep in mind and listen for the warning signs, and maybe you can impart some of your knowledge. So what is loan fee fraud? Well, it is when consumers are asked to pay an upfront fee for a loan or credit that they then go on to never receive. So most loans, most reputable loan providers will charge either a loan fee or they'll charge a percentage on the loan, but it will either be incorporated in the loan itself or the charge will be added on to the loan. And so obviously there's a warning sign there. If you hear of a loan being offered where you're asked to pay an upfront fee before that loan is secured, then that should ring a little alarm bell. So the FCA has said that there are 3 warnings you need to be aware of. And this is where the FCA have shown a little bit of humour, I think. They've called it 3 wise warnings, obviously good for this time of year, the 3 wise men. And these warnings are, number 1, are you being asked to pay that fee up front? If you are, think about it. That might be a bit of a warning sign. Are you then being pressured to pay that fee quickly? So is someone hassling you and saying, come on, we can get this loan for you, you just need to pay this fee? And are you being asked to pay it in an unusual method? So think about gift cards or PayPal or logging onto portals that you're not sure are secure or via a phone line. All of those things are things that you should be looking out for. So you yourself, you might feel confident that you could spot a potential fraud taking place, but research says that 1 in 4 people have said that they'll be happy to pay a fee up front in order to secure a loan. And that should be a red flag. And that actually rises to 1 in 2 people in the 25 to 34-year-old age bracket. So just have a think if you've got any friends or family that have maybe been struggling, have been furloughed this year, are struggling for money and are talking about maybe unusual ways of securing some money or a loan over Christmas, and maybe just make sure that they're aware of these warning signs. And lastly on this, if in doubt, before agreeing for a loan, always check who you're dealing with, and you can do that on the FCA register.
Okay, so that's it. We're done, aren't we?
That's it. We're done. The 300th episode in the bag. And so if you want to get in touch with Damien, you can do so in the usual way. It's Damien@moneytothemasses.com. If you want to get in touch with me, it's Andy@moneytothemasses.com. Don't forget, of course, we've got the Facebook group. We managed to get up to the 2,500th milestone that we're looking for. So thanks to all the new members that have joined the group. Please do continue to add yourselves to that group if you haven't already. We love to have you there. It is facebook.com/groups/money to the masses. And if you've got an idea for the podcast, you can always drop it in that group and we can start the discussion. And finally, of course, if you can review the podcast, that will be fantastic. It helps us flying up the charts and enables us to help more people. So that's it. We're done. Damien, until next time.
Until next time.